9 basis points. That is how far the American 30-year bond yield fell on Wednesday, the 19th of August, 2026. One session, one announcement. The announcement said the Treasury would buy back more long bonds. Here is the awkward part. On the day that yield fell, the Treasury had not bought a single extra bond, and it would not buy one for another 3 weeks. By Friday's close, the 10-year yield was higher than it had been the day before the announcement. So what did the market actually buy that Wednesday? I want to put 3 documents next to each other with you. The press release in its own words, which never once uses the word yield, the size of the thing in dollars from a schedule the Treasury published 2 weeks earlier, and a second yield curve, published every day, quoted far less often, which tells you exactly which part of the price moved. Then we go to Singapore, where a 30-year government bond sat through the entire episode and moved 1 basis point. Ready? None of this is advice. It is arithmetic, and you can check every number yourself. Chapter 1: The Day It Worked. Start on Monday, the 17th of August. That afternoon, the United States 30-year Treasury yield closed at 5.31%. What? How unusual is that? I checked it against the Treasury's own daily files rather than anybody's headline. Every trading day from 2007 to now searched for a 30-year reading of 5.31 or above. Exactly 1 year before this one contains any, 2007. Its high was 5.35% on the 12th of June. So that Monday closed at the highest 30-year Treasury yield in 19 years. Tuesday it eased a little, 5.28. Then Wednesday morning, the Treasury put out a press release. It was public by 10 minutes to 9 New York time. I can date it that precisely because that is the timestamp on the Consumer News and Business Channel's story about it. And the market moved. The 10-year fell 6 basis points, 4.71 down to 4.65. The 20-year fell 11. The 30-year fell 9 from 5.28 to 5.19. If you would rather see that in something you can actually buy, the iShares exchange-traded fund that holds 20-year-plus treasuries rose 1.67% that day on 51 million shares against 25 million the session before, more than double the volume. One housekeeping note, because on this beat it matters. Those yields are the Treasury's own par curve. Its published method says they come from indicative bid-side quotes on the most recently auctioned securities collected by the New York Fed at or near 3:30 in the afternoon, not transactions. Quotes the same convention every single day, which is what makes comparing them honest. The framing was immediate and it was unanimous. The Consumer News and Business Channel headline, Treasury doubles debt buybacks as Besant moves to steady bond market. The web address of that story ends with the words sending yields lower. The article says, and I am quoting it, yields tumbled following the announcement and stock market futures surged. NBC News, 5 hours later. Bond yields fall after Treasury announces surprise move to ease rising rates. Both of those are the same story, a government stepping in to push borrowing costs down. And on Wednesday, the tape agreed with them. Hold that Wednesday in your head because everything after this is about what happened to it. And ask yourself as we go, what were those buyers paying for? By Thursday, the 30-year was back at 5.23. By Friday, 5.27, 8 of the 9 basis points. Gone. And the 10-year, 4.74. 3 basis points higher than before the rescue. 3 sessions, the whole thing undone and then some. So either the market changed its mind about a policy that had not started yet, or it never understood what it was reading in the first place. Which one do you think it is? The press release is 4 paragraphs long. Read it with me. Chapter 2, 4 paragraphs. Here is the title of the document, exactly as the Treasury wrote it. Treasury announces increased sizes of nominal long-end liquidity support buybacks beginning September 9. Read it again and notice what is missing. There is no yield in that sentence, no borrowing cost, no interest rate. The 2 words carrying the weight are liquidity support, which in the Treasury's own buyback vocabulary is a category name. Now the body, all of it is short. Paragraph 1. The Treasury is increasing by at least double the size of liquidity support buyback operations for longer-dated nominal coupon securities, the 10 to 20-year sector, and the 20 to 30-year sector. The current maximum size of $2 billion per operation will be at least $4 billion per operation. Paragraph 2. The change is effective the 9th of September and runs to the 4th of November. More information at the next quarterly refunding. Paragraph 3 is the one that decides the argument. Quoting it in full. This increase in buyback operation sizes reflects Treasury's desire to provide greater liquidity support in longer-dated nominal sectors, where there is consistent strong sponsorship from market participants. As evidenced by the significant volume of high-quality offers Treasury routinely receives in longer-dated buyback operations. Paragraph 4. An updated schedule will follow. That is the entire release. I searched the text for the word yield. It is not there, not once. Neither is interest rate, neither is borrowing cost. So what reason does the Treasury actually give? That dealers keep offering it more bonds than it is allowed to buy. That is a plumbing complaint. It is the sentence you write when the bucket is too small for the queue, not the sentence you write when you are trying to move a price. And look at the date once more, effective the 9th of September. On Wednesday, the 19th of August, not one bond was bought at the new size. None was scheduled to be for another 21 days. Would you like to know what the Treasury did do that Wednesday? It sold bonds. At 1 o'clock New York Times, hours after the release went out, the Treasury auctioned $16 billion of 20-year bonds. 16 billion sold against a promise to buy up to 4 billion at some point in September. 6 days earlier, on the 13th, it had auctioned $25 billion of 30-year bonds. Add those up yourself. In the month of August, the United States Treasury offered $41 billion of new long bonds to the market and announced that from September it might buy back an extra $2 billion per operation. You could call that many things. A rescue is not one of them. But wait, maybe $2 billion an operation is more than it sounds if there are enough operations. That is a fair objection, and there is a one-page document that settles it completely. Chapter 3, 14 billion maximum. On the 5th of August, 2 weeks before any of this, the Treasury published its tentative buyback schedule for the quarter, 20 operations, dated, sized, listed from the 6th of August to the 5th of November. One page, it is the most useful thing in this entire story, and it was sitting in public the whole time. Count the operations the new rule actually touches. 10 to 20 year and 20 to 30 year, announced on or after the 9th of September. There are 7 of them: the 10th of September, the 24th, the 1st of October, the 8th, the 15th, the 27th, and the 4th of November. 7 operations, $2 billion extra apiece. $14 billion. That is the whole increase, the entire extra capacity created by the announcement across the entire remainder of the quarter. Now put it against something. Pick the biggest number you can think of for the American bond market, then compare. The Treasury's monthly statement of the public debt, as at the 31st of July, puts total marketable debt at $31.455 trillion, of which bonds, the 20 and 30-year class specifically, are $5.489 trillion. 14 billion into 31.5 trillion is 0.044%. What? 0.04%, that is your bazooka. And there is a column on that schedule I have not mentioned yet. Every single row carries a minimum purchase amount of $0. 4 billion is a ceiling, the floor is nothing. The Treasury has not committed to buying one bond. Now the detail I find most telling in the whole file, and it is in the same table, 4 columns to the right. What size were the Treasury's other liquidity support operations already running at before any of this happened? 1 month to 2 years, 4 billion. 3 to 5 years, 4 billion. 5 to 7, 4 billion. 7 to 10, 4 billion. 2 to 3 years, 4 billion. 4 billion, all of them already. So at least double does not create a new weapon. It brings the long end up to the size every other part of the nominal curve had been running at all along. Does that sound like an intervention to you? It reads to me like a form being brought into line with the other forms. One more line from the same page, and then I will stop with the schedule. In that same quarter, the Treasury has 2. Cash management. Buybacks booked, the 3rd and the 9th of September, at $12.5 billion each. 3 times the size of the doubled long-end operation, published on the 5th of August, and as far as I can find, not one headline. So that is the size argument, but size alone does not prove what moved on Wednesday. For that you need to know which part of the yield moved. And the Treasury tells you that too, every single day, in a file almost nobody opens. Chapter 4: The Second Curve. A nominal bond yield is not one thing. It is at least two things wearing a single number. There is what a lender demands in real terms after inflation for tying up money for 30 years. And there is what they need on top of that to cover the inflation they expect along the way. The Treasury publishes both. Every trading day it puts out the par yield curve you have already seen, and alongside it on the same page, on the same 3:30 convention, real yield curve derived from inflation-protected securities. Subtract one from the other and you have inflation compensation. Traders call it the break-even. So take the 19th of August apart with me, 3 numbers and you will have it. The 30-year nominal yield, 5.28 down to 5.19, 9 basis points. The 30-year real yield across the same 2 days, 3.03 down to 2.94. 9 basis points. And the break-even, 2.25, then 2.25. 0. It did not move at all. Do the 10-year and you get the same picture, nominal down 6, real down 6, break-even 2.30 then 2.30, 0 again. Both tenors not approximately 0. 0 to the second decimal place the Treasury actually publishes. You can pull both files in about a minute and see it. So whatever the market repriced that Wednesday, it had nothing whatsoever to do with inflation. That kills one of the explanations that had been in the air all week, that long yields had run up on inflation fear and were now calming down. On the day itself, the inflation component of the yield did not move by a single 100%. Now one honest qualification, because this number gets overread constantly. A break-even is not a survey. It is inflation compensation as priced, and inside it sits an inflation risk premium and a liquidity discount on the inflation-protected bonds themselves. It is not a clean readout of what anyone expects. But both curves come off the same desk, on the same day at the same 3:30. So when one moves 9 and the other moves 0, that comparison is telling you something real about where the move sat, even if it cannot tell you why anybody wanted it there. And where it sat was in the real yield, in the price of duration itself. Which raises the obvious question. If the announcement pushed the real cost of holding a 30-year bond down by 9 basis points on Wednesday, what pushed it straight back up on Thursday and Friday? Chapter 5: Given back. Hold Wednesday's numbers in one hand. Now watch what the next 2 sessions do to them. Thursday the 20th, Friday the 21st. 30-year 5.19, then 5.23, then 5.27, up 8. 10-year 4.65, then 4.69, then 4.74, up 9. Set those against where they started the day before the announcement. Line them up yourself. The shape is unmistakable. The 30-year finished the week 1 basis point below its pre-announcement level. The 10-year finished 3 basis points above. 3 sessions after the rescue, America's benchmark borrowing cost was higher than before the rescue. And the giveback went the same way the rally did. Of the 30-year's 8-point rise across Thursday and Friday, 6 came out of the real yield and 2 out of inflation compensation. Of the 10-year's 9, 5 were real. Real yields did it on the way down. Real yields did most of it on the way back up. That exchange-traded fund I mentioned, the 20-year plus Treasury tracker, had gained $1.36 on Wednesday. By Friday, it had handed back 97 cents of it. 71% of the rally gone in 2 days. Now bring in the market you probably watch more closely than the bond market, because it sharpens the point. If falling long yields are what the Nasdaq wants, Wednesday should have been a good day for it. Consumer News and Business Channel reported that stock futures surged on the announcement. So what happened at the close? Look at it before you decide. The Nasdaq Composite rose 0.16%. Fine, but the Nasdaq 100, the mega-cap index, the one people mean when they say the AI trade, fell 0.22%. What? On a day long yields dropped 9 basis points, the Nasdaq 100 closed down. Then Friday, yields up 5 basis points at 10 years, 4 at 30. The Nasdaq 100 rose 0.33%. The composite rose 0.43. Yields down, index down. Yields up, index up. If you have been told long yields drive the AI trade, that is the mapping. And it failed you in both directions inside 1 week. That is the opposite of the story, twice, in 3 sessions. And across the 4 sessions from Monday's close to Fridays, the composite lost 1.74% and the Nasdaq 100 lost 2.29%. So what was actually being repriced that week? Not inflation, and not for more than a single day the supply of long bonds. You want a control for that, a long government bond that was not caught up in any of it. And there is a very good one, 12 hours ahead of New York. Chapter 6, the bond that did nothing. Singapore closes first, that is the useful thing about it. Its exchange shuts at 5 in the afternoon local time, that is 5 in the morning in New York, 10.5 hours before the Treasury takes its 3:30 reading on the very same calendar date. So when a press release lands in Washington at 10 to 9 on Wednesday morning, it is 10 to 9 on Wednesday evening. In Singapore, that market has been shut for nearly 4 hours. Which means the Singapore session that gets to respond is Thursday. Get that wrong, compare the wrong 2 days, and you will reach the opposite of the truth. So Thursday the 20th in Singapore. The Monetary Authority publishes daily benchmark yields, bid rates quoted by its primary dealers. On Wednesday, the Singapore 10-year sat at 2.36%, the 30-year at 2.49. On Thursday, reacting to the American announcement, 10-year 2.37, up 1 basis point. 30-year 2.48, down 1. That is not a reaction, that is noise. The American 30-year had just fallen 9, Singapore's moved 1, and by Friday was back at 2.49, exactly where it had been on Wednesday. Now look at the levels and ask why they sit so far apart. On Friday, the American 30-year closed at 5.27%, Singapore's closed at 2.49. 278 basis points. 2 governments, same maturity, same week. And here is the structural thing I think the America-centered version of this story keeps walking past. Singapore's Ministry of Finance says this in writing on its own website. Under the Government Securities Act of 1992, the Singapore government cannot spend the money it raises from these bonds. They are issued, in the ministry's words, to develop the domestic debt market. The proceeds are invested, and the investment returns cover the interest. Read that twice. Singapore issues long bonds it is legally forbidden from spending. Does that sound like the same instrument to you? So whatever sits inside that 2.49%, it cannot be a premium for future deficit-driven issuance. There is no deficit at the other end of the instrument. Singapore's equity market barely blinked either. FTSE Russell puts 3 banks at 56.69%. Of the Straits Times Index, on the Singapore Exchange's own price feed, all 3 closed lower on Thursday and higher on Friday. And DBS finished the week at $76, the same price it closed at on Wednesday. Chapter 7, what this is and what it is not. The Singapore comparison is easy to overclaim, so here is the boundary I am holding myself to, and the one I would ask you to hold me to. That 278 basis point gap is not caused by that statute. 2 different currencies, 2 different inflation histories, a central bank in Singapore that steers an exchange rate rather than an interest rate, a captive base of domestic buyers, all of that is in the number. Do not let anyone, including me, sell you a 1992 act as the explanation for it. What the statute establishes is narrower and more interesting. These 2 30-year bonds are not doing the same job. One funds a government, the other exists so that a bond market exists. Which is why the week reads the way it does. If what the American long end is pricing is the real cost of absorbing bonds from an issuer that has to keep selling them, then a $14 billion rise in a purchase ceiling with a floor of 0 starting 3 weeks later is simply not addressing the thing. So what would show you I have this wrong? 3 things, and you can watch every one of them in the same public files I used. If the 10th of September operation comes in materially above $4 billion, genuinely open-ended rather than a doubled cap, then it was a policy signal after all, and I underweighted it. If the 4th of November refunding cuts long-end auction sizes, then the buyback was the trailer and issuance policy is the film. And if the 10-year settles back below 4.71 over the coming weeks, it's level the day before all this, then Friday was noise, and the announcement did lasting work I have written off too early. Until one of those happens, the arithmetic stands where it is. Go and check it. The schedule, the 2 curves, the auction results. They are all free and they all disagree with the headline. 9 basis points, $14 billion, and so far 0 bonds bought.